So I suppose as an investor, Ross, from my point of view, I'm quite curious to know that in terms of the bank assessing your loan and borrowing capacities, what are the changes from the bank's point of view in the last few months or so?
Yeah. So hands up who is aware of sort of what's been happening with APRA and ASIC over the last sort of 4 or 5 years. Okay, so yeah, I'll go back and I'll sort of explain it from 2014, December 2014, the changes came in. APRA puts guidelines out to the bank to tell them, and it's the ADI, so it's the deposit-taking institution. So basically anyone that you can open a bank account with, they came under these guidelines. And the guidelines were, you're to assess loans in a certain way or we'll get out our big stick. And the big stick is they need to hold more money in capital against their loans. So they don't want to do that, so they need to comply. So rather than, we've probably had half a dozen lenders at that point in time assessing your loans at what your actual repayments were. So if you were $1 million at 4.5%, the banks were assessing your existing repayments on your loans at $45,000. Now, so the APRA turned around and said, no, we want you to do it at a benchmark, and that benchmark is 7.25% interest rate. We want to calculate it at principal and interest repayments. I know you're paying interest only, but we want to calculate it principal and interest repayments, and we want to take it over the remaining term, which is going to be 25 years, because you've got 5 years interest only and you've got 25 years principal and interest. So we want to do it over the remaining term. So what that does to your borrowing capacity, instead of them looking at $45,000 in repayments a year, pretty much doubles it. So they're looking at around about $90,000 in repayments that you're paying. So for anyone with a decent sized portfolio, if you've got, say, $4 million, you're looking at an extra $180,000 in net income to qualify for the same amount of money that you used to be able to borrow. So it caused a massive hit in terms of actual borrowing capacity.
I suppose, Ross, all the additional sort of changes, right, in terms of your living expenses as well as your utility bills and the investment properties.
Exactly. What Munzerul is saying is what's happened is, with ASIC, is really cracking down on, well, we don't want to just take a standard view on what someone's living expenses are. We want to really go down deeply, and those of you that have applied for the loan in the last couple of months will realise you've had to provide 3 months worth of bank statements for your transaction account, so we can see the amount of money that you're actually spending. So we used to take a declaration from the clients, I'm spending this, this and this, but now they're some of the things and some of the questions we're getting asked, we were joking amongst the brokers, someone asked what a $30 chemist bill was the other day, like $30 for a chemist bill, and they're going through a statement on that. So
some of the things which I was adjusting literally today, a client of mine is that we presented the financial set of accounts, and the bank came up with a proposition saying, well, there is a certain loan, which is a director's loan, that we recorded that as a current loan. And the bank's proposition is that you need to change that into a non-current loan, and the loan will be approved by changing it from current to a non-current. That's sort of phonetics, so to speak, and going into that level of sort of details with my 22 years of experience, I haven't seen.
Yeah, exactly. And why is this coming? So there was a Banking Royal Commission into the misconduct, and some of the banks sort of have been taken over the coals, and you have a responsibility to really crack down on living expenses for these particular clients, and Westpac have been fined, and a couple of others, ANZ got into hot water over it. So hence the big crackdown. So everyone's running scared, the credit assessors are running scared. And so the other area that we've looked at is in terms of property investment expenses. So let's say, for example, your rates and utilities on a property minimum is going to be $2,500 a year. Probably, I would say, if you've got Queensland properties, it'd be more than that. But let's say, for example, they were, and you had a 10 property portfolio. That suddenly added an extra $25,000 worth of living expenses that are onto your expenses that the banks are now factoring in. So this, of a borrowing capacity, what does that mean? That means, $300,000 comes off how much you can borrow, which is massive. Just for a small change in terms of how they're looking at actually assessing your loan. So, with these things, higher living expenses, so they're actually taking a more detailed look, investment property expenses and tighter servicing amongst the big banks, it means that a lot more people aren't qualifying for loans that they used to be able to. So what flow-on effects does this have? So hands up if you've got interest-only loans on your investments. All right. So what happens once those interest-only expire is you will need to reapply to extend those interest-only. And so what you need to do at that point in time is the bank, and again, this has come from those APRA guidelines, the APRA has recommended that any change in a loan contract will need to be assessed under their new criteria. So even you got it approved 5 years ago at the old criteria, when your loan comes off the interest-only period, you need to get it reassessed based on the new criteria. And so a lot of people will fail that new criteria, so they need to look at, well, what options do I have and what are my strategies that I've got in place to continue these loans.